Mm.
Hello, hello, hello.
Welcome.
Welcome, Random Rabbit. This is podcast number 19. You guys are coming to us on a Monday, which is always a beautiful day because everything is open. I'm just kidding. What's going on, guys?
Mondays are
Welcome.
beautiful days because everything is open.
Everything's open. All right.
When you live in New Jersey, everything's always open. There's
Welcome,
never
Random Rabbit
day,
Jeremy.
Friday, Christmas, don't matter.
Goodness, everyone in New York just ready for pizza?
Well, I tried getting Thai food today, and there were a lot of places that were closed, so kind of disappointed.
Well, you live in like Ohio.
Do you live in Thailand?
You have like a higher density of tornadoes than you do human beings.
There
This is
is
true.
no
This is true.
Thai food.
So you're just saying move out of Ohio?
I mean, look, there's a reason that the
No,
landlocked states
no.
were paved for farmland and not for other things, because that was all they were good for.
Yeah, gosh.
Well,
There are open swaths of land for growing food. It's the best way to use it.
with that, this is a commercial for Ohio. Come on over. The group, the food might not be great, but the people are, and so come down. You will enjoy it. You will love it here. And with
Josh
that,
referring to himself. The people,
Gosh,
me,
I
are
make
great.
a mean barbecue.
we need Korean barbecue in our life. Is that what you just said? Because I
Why
completely
don't you open
agree.
a Korean
Well,
barbecue
it
place?
could be Korean
Josh?
barbecue as well.
Korean barbecue sounds amazing. So with that, let us start the news with Wyatt.
All right. Yay! All right. So, first up in the news today is Cuba cracks down on protests by its citizens as they are upset about the recent surge in COVID cases, but most importantly, they're kind of tired of being ruled over by an authoritarian regime. So thousands of demonstrators and activists took to the streets, and at least 80 were arrested across 15 different cities in Cuba. And the president of Cuba is trying to blame U.S. embargoes for the cause, for the economic strife, because they are facing one of the worst economic crises in over 30 years. This includes food, fuel, and medicine shortages, rolling blackouts, and a large number of surging COVID cases. So if you see that in the news, that was kind of like the feather that broke the camel's back was, more people getting sick, but that's not the main driver of what's happening here. A lot of people that were arrested were dissidents and civil rights activists who were calling for freedom and end to President Miguel Diaz, D-I-A-X, to an end to the President Miguel's reign here. He's been going for the communist government here has been around for about the last 6 decades, roughly, and he took over in 2018. And they said in the article that they had everybody out there from plainclothed police officers to Communist Party militants with quote-unquote hefty sticks. So they were just beating people with sticks, whatever they could to quell the protesters. And the government has vowed that they will not yield to the protesters' demands. They will have to go over our dead body if they want to overturn the revolution. Mr. Diaz-Canel said. So there is definitely going to be like a flashpoint here. These demonstrations are calling for freedom and an end to the communist regime, and they don't want to have to leave Cuba to do it. They don't want to have to go to the United States and get on rafts or try to immigrate somewhere else. They want their country to be open and free. They feel that their government has been very restrictive to them. And the really question is, can the people handle what's going to happen next? This is unprecedented for Cuba, given how severe the government is in cracking down on dissidents. And then people just took to the streets. Like they didn't care about what happened to them because they're finally fed up. And like, we're just going to let the world know. And this is really a good example of a function of the internet at work and people being able to communicate and finally realize, like, everybody else here, we're all on the same page. Like, there is other ways to live life. Like, this isn't working. We have something to say about that. So, and something interesting here is that the Freedom House, a nonpartisan organization dedicated to promoting freedom and democracy, reports that freedom across the globe has declined for 15 straight years, a trend that accelerated last year. I have no idea how they are rating that. I imagine it must be something to do with population density versus leadership versus government types in countries, something like that. But the point is that it's actually interesting when you look at it, because you're seeing a lot of the bigger influential countries in the world actually moving further away from democratic processes, even though maybe their citizens are calling for it and trying to lock down onto their own different types of government and move forward with their programs and regimes. Such as in Iran, the Ayatollah has been in power for about 32 years straight, and Russia, Vladimir Putin's been the president and PM for about 22 years, trying to approach Stalin's record, which was 29 years of leading. So that's going to be interesting to see. Critics and analysts alike both think that Vladimir Putin will be alive to see that through. And in China, Xi Jinping has been in power for only 9 years, but he removed term limits, and he basically has a cult following of political entities that are basically willing to vote him in and say do whatever that he needs to do. So we'll probably see him around for a while as well. So really, what this is being viewed as kind of like another big moment of people wanting democracy, people wanting to not be controlled or ruled anymore, being upset with their government and saying, like, we want a different way. We want to try something different. This isn't working and we don't like it. We don't think you can solve the problems of our country. We think you're only going to make them worse, and we want to take our country back. So we'll definitely be watching to see what happens, but definitely something that we should know about, since Cuba is just right off Florida, is a very, very large communist regime. So definitely some interesting news today coming out of Cuba.
Yeah, well, I hope. I don't know. I was watching the show Startup, and I feel like they're still. I'm not sure if they've come up to the 20th century, but I know they're pretty delayed in their technology.
Right, and some people believe that what might happen here is that the Cuba's government may restrict certain internet access and may limit the ability of them to communicate and for people to communicate outside of Cuba, and may be cracking down on that as well. So, but then again, that's the thing, when you're going to find, except for exception of really China, because China's a little bit different. They've kind of done a more hybrid style model here, but for most authoritarian governments, you generally don't see large advances in technology, because that coincides with with the amount of power within those companies or entities, as well as more freedoms and spread of communication from the citizens, which generally doesn't work in your favor, because if you're trying to maintain control, if people don't love you because they think you're a great leader, then you can only control by power and fear. And if you find a way to kind of backdoor that and let people learn about the rest of the world and learn the truth and have that voice, you start to wither away at that power. So,
Cool. Thank you. Okay. Yeah. Well, good luck to Cuba.
Good luck to Cuba.
Yeah.
Biden has sided with the protesters as well. So, I don't know if there'll ever be any kind of U.S. involvement in that.
I mean,
we'll
at this point, it's just holding back their whole country. They're holding back everything from getting further in technology to when people even started going over there during the times where vacation was allowed from the U.S. into Cuba. Well, they ran out of resources pretty quickly. So,
right. Yeah, Cuba's been a communist regime for a while, since the Castro brothers. So we'll see how it goes. But apparently, as I said, the government's not bending. Will not give in to the protesters. They'll have to take it back over their dead bodies. So I imagine it will not be, if there is a transfer of power and these protests turn into something more conclusive, I don't think it'll be peaceful, or in both ways. I don't think it'll be peaceful in the protesters being quelled either. So definitely gonna hopefully not see any more violent news out of there, but I imagine we'll see some more stories about Cuba. So if you see Cuba in the news, that's what's going on.
Okay.
All right, up next, we're going to talk about the global debt hitting record highs for almost every single country. And what's happening here is we're seeing a new way of thinking about debt in the world, right? We're seeing a new way of countries saying we can keep borrowing so long as we keep our interest rates low enough that we can manage the payments on our debt. As a result, we're kind of really pushing the limit of how much debt we can have, because we're saying we can just keep paying for things and supplying economies with money, because as long as we keep our interest rates very low, our maintenance cost of being able to pay back that debt is very low. So it gives us the ability to keep doing that. And the U.S. is about to have over $3 trillion deficit for the second year in a row. But the U.S. Treasury yields at 10 years down at 1.33%, which means their real yields are negative when taken into account with inflation. And interest rates and prices are inverse, right? So when interest prices drop, it means the prices of bonds are increasing. That's because people are buying them. right, and vice versa. So why are people piling into debts? Well, some theories are that they don't expect them to stay, these real rates to stay negative for long. They expect there to be a turnaround, or they're looking to pile into something safer with expectations of more deflation coming in the future. So we'll see how all that plays out. But around the rest of the world, you look at people like Japan's about to hit 10 trillion US dollars in debt, which is 250% of their GDP. However, they're not paying more in interest each year than they did in the mid 1980s, back when their GDP was only their debt was only 66% of their GDP. So it's really a balance between interest rates and the amount of money being taken out here. So as long as you keep your interest rates low enough, it's easy to maintain that debt. And this is interesting. So there's a chart in there, but the all-time borrowing has exploded from an average of about 30% GDP in the 1970s across the top 20 economies to about 125% of GDP in the last 2 or 3 years. And in contrast, when you look at interest rates, the cost of borrowing here, that's plummeted from about 12.5%, for instance, in average or in the 80s, to about close to zero today. The United States at 1.3% for their 10-year yield. Other countries like Greece, everything have much lower rates, some even approaching negative rates. So, you have very, very low interest rates, and that allows you to borrow and borrow more debt because paying it back, your payments are so low. As long as you can keep your economic growth at a level higher than the interest you have on your debt, and your interest is very, very low, making those payments is easy. And as long as you budget for that, you're able to keep basically borrowing and balancing against it and saying, well, our payments are still low. The problem is when you raise interest rates, that's going to cause a major problem, because all of a sudden you're going to be tacking on tons of new money for you to maintain your debt. So that's going to be harder, and it's going to be harder to get new money. So those compounding effects are really what people look at in the long term, is how long can it last before you have to raise interest rates, and how much can you raise them and balance, kind of stop your economy from overheating versus not blowing yourself out and having to default on debt because you can't make those payments. So this is really, and this is not a bad thing, right? Spending lots of money is not a bad thing. When you have like a coronavirus effect, right? You kind of have these problems that are global, and you have to pay for everything. So paying for things isn't a bad idea. The only problem is as this keeps happening, we keep spending more and more money. That analysts are saying and looking at the market, you're saying, why are they doing this? Last time we didn't do enough, right? It's viewed that we didn't do enough last time to pay for things during 2008 and other crises before that, and that's why a lot of jobs disappeared. That's why a lot of people lost their jobs, lost their homes, was because we didn't do enough to stimulate the economy. We had stuff like stagflation and problems in the economy. We didn't see a lot of economic growth post 2008 for some period of time. It took a while to get back off the ground. So the idea now is to avoid that. We'll just spend lots and lots of money, and we'll beef the economies up. And once they have all this money, that'll propel them to grow even faster out of these losses. So and then on the counter side, it's, well, we're taking on too much debt, our inflation is getting too high. What are we gonna do about that? So the idea here is that there's a massive bet on the secular stagnation hypothesis, where a lot of people are betting on private savings and as an investment for a long time. So the amount of money that's being saved is putting all these bonds, everything in the market. That savings will allow us to be able to keep paying down our debt at those minimum payments for an extended amount of time, giving us the ability to borrow more debt because our interest rates are so low. So we can just keep borrowing and borrowing and spending and just paying the minimum for as long as we possibly can. So this is something that we're going to have to be taking a look at. And as of now, global debt is over $90 trillion US dollars across the world. And it just really goes to show that we thought there was a limit on debt, but it might actually be a lot further away than we think. But that's also because of these conditions, and we're kind of entering uncharted waters here. So we're going to have to keep our eyes on this. But the key here is the sustainability of the relationship between interest rates and growth. So as long as the country grows faster than the rate it pays, it's fine. Like I've said, as long as your economy is growing fast enough, you can pay your minimum payments. But if the interest rate exceeds your growth, whenever that happens, that's when you have some serious problems. So you can see that inflation can help your GDP and can help with tax revenues as well. These can all help fight against inflationary forces and help beat down on your debt. But we'll see how that goes coming in the future, because we have to find a balance for this, right? So really what it's saying is everyone's got a lot of debt. Everyone's trying to balance that with low interest rates so they can keep on borrowing to spend, so they can avoid having a stagnation and a lack of economic output going forward after all this. The question is, where's that balancing and the tipping point, right? How do we keep everything in balance to make sure that this is sustainable? We don't borrow too much and put ourselves in a position where we might have defaults. We might have problems. Because if we plan to raise interest rates in the next 2 or 3 years, companies, firms, individuals, governments, everybody's going to have to make sure their debt is not crushing them. Otherwise, those increase in interest rates are going to really hurt people. They're really going to pound down on everybody at every level.
Yeah, Janet Yellen just came out last week and said that it would be inconceivable for the United States to default on its debt.
Right.
So it is,
Because
well,
that's go ahead. Go ahead.
no, I was just saying that, for countries just like ours that have the same sort of economics, when they say default, it's other countries have done that and they've come back. There are strategies to these things, but the United States has never defaulted on their debt.
Yeah, and it's important that the United States doesn't default on its debt, because if your country never defaults on its debt is viewed as safe. Your debt is the highest rated. You're everyone wants to do their business in U.S. dollars. Like, we look at the United States economy, we say this is the strongest economy there is. This thing's never going to fail. Therefore, we can borrow in U.S. dollars. We can denominate our debt in U.S. dollars. We can accept U.S. dollars. But as soon as you show that it's human, that there's a crack there that can be exploited, it's just like everybody else. That, I think, would cause a major, not only material impact to markets around the world, but psychological impact for going forward, is how people view where they put their money for safety. Because right now we rely on people buying lots of government bonds. We rely on other countries taking their savings and putting them to work in government bonds so that we can actually make more money and borrow. We can keep bringing the capital in and then pay off those interest payments. So it's also a psychological thing. We really don't want that to happen. And again, I don't think we will see that happen because we can print money. But that's not necessarily the problem. Like, yeah, we never defaulted on our debt, but if we cause a type of hyperinflation or some similar type event, that will be very bad domestically, which can then lead to the potential for defaulting as well. So it's really just, I found that interesting to read about, is how many countries are pumping in debt, and really just this psychological and methodology change in how we deal with debt, how we view too much debt, and how we're trying to balance, right, how much spending we're doing with what we can actually afford to repay. And I just thought that was interesting. It's really just all about interest rates, and those are going to become very important in the next couple of years as more and more debt
Congress
exists.
has up till the end of the month to get their act together and either decide if they're going to move the debt bar up, or they're going to just keep it as it is and do a stagnation for it, like what they've been doing, and not have to deal with that problem right now.
I mean, they're definitely not going to. I think they'll wait to the last minute. I think that they'll say, like, parts of the government have to, like, shut down or blah blah. They're gonna talk about all these fears, but I don't think that's going to happen, because again, there's a much bigger picture here. And if what we understand, if this is the new understanding of debt, then we probably have more wiggle room to go. I disagree with it in the long term, as I think a lot of people do, but that's how this is working. That's how we're managing to keep doing this. Is we have hundreds, almost $100 trillion in global debt via countries, but as long as we can make our minimum payments, that's fine. So, if you're a consumer, you hit a debt limit and then you can't borrow anymore because you're viewed too risky. Well, how does that work with countries? How much debt do people have? How much leverage can exist before something goes wrong? And that's going to be, I think, when interest rates hit, and depending on future growth. So really the balance is keep your countries growing faster than your rates on your debt, and keep your rates on your debt as low as possible. And as long as you maintain that over time, the theory is that you will slowly eat away at your debt. It will slowly begin to pay itself down. But I guess the only problem is if we just keep spending and spending and spending, we can, it's all about keeping it sustainable. If we lose the sustainability and the balance, then we're screwed. So it's going to be interesting to watch. But this all kind of ties into our general inflation, debt, future economics, what the next couple of years is going to be like. So I just thought it was interesting to bring that up and talk about that. And I learned some stuff about it too, digging more into learning about interest rates, bonds, these different markets and different parts of the market that move capital as opposed to being traded by retail investors. So,
yeah,
very interesting. Okay, and after that, the last topic I'm bringing to the table here is news on the inflation expectation. So, a couple of good articles across the Wall Street Journal and CNBC today covering some factors for inflation, and I thought they were just very interesting. So, I was going to talk about that today. But for the past few decades, prices or inflation has been kept in check. But now things are changing, right? The pandemic has made a lot of changes and made a lot of disruptions that are changing the way people view a lot of things. And one of those big changing factors is reverse in globalization. So in July of 2011, the U.S. hit 32% of their GDP was due to trade. By October of 2019, right, just kind of before we started really getting into this pandemic stuff, it had already decreased to 25%. It tanked obviously down to like 20% during the pandemic, and now it's back up to like 24. But the point is, there seems to be a longer term trend here where after 2011, we've seen to just kind of be less and less, which I think has to do with trade wars and all these tariffs we're throwing on people, as well as a push for make American. But the problem with that is, okay, so we're not doing as much trade. That's not contributing as much to our GDP. The problem here is that trade has deflationary measures, and what it does is it creates competition. More competition creates doesn't let people raise their prices. So when you look at from the 1990s to 2019, goods increased in price by only about 20%, while services increased by about 147%. The difference there is because you were getting a lot of other goods being imported and being bought and sold from other places, so you were able to afford to pay for things more cheaply that another country could make more cost effectively, and you didn't have to make it, versus you could sell things that you were better at making, and then other people would pay for those things. So it was more efficient. But we're starting to see kind of an age of protectionism, right? When you look at the United States and China especially, people saying, we don't want to rely on other supply chains, we don't want to rely on other countries, we want to rely on us. And that means that you may be producing more products that you don't have the comparative advantage for, so you're going to be spending more. It's going to be naturally more expensive to make them, meaning inflation will naturally increase as you refuse to get lower cost products from other countries because you want to protect your supply chains. This also became a very big deal during COVID because we realized just how much we rely on all these other places for goods and how much of an impact it had when those supply chains shut down and the things that we're seeing. So people started to say we need to bring more of that stuff onshore for our own benefit, and we need to build them even if it costs more money. So that could help drive up inflation. And this is great. Again, like I said, it's great to have you're building your own products when you have something like COVID, because your country can be self-sufficient and you can build your own products. You don't have to rely on trade. But then the rest of the time, you're not using your comparative advantages and you're producing things you're not as efficiently as you could be, and therefore you're forcing inefficiency by saying we're going to create these things even if there's an easier way to do it or it's cheaper to buy it. Another changing factor is the aging demographics. So we've heard about this from America, we've heard about this in China, but in general, right, in economics, when you have lots of people in the labor force, those people are generally saving as they work. And in general, in aggregate, workers produce more than they consume, right? So if you have a giant working class, then you're going to be generally as a country saving more money. And that is deflationary, right? Because you're saving money, you're not spending as much, you're thinking about retirement, so you're not putting as much demand into the market. However, the flip side of that is the dependencies, the literal dependence. Now, in the United States, you're seeing that you're having more U.S. dependents growing very rapidly, and they generally put a lot more demand and they do a lot more spending, especially when they're younger. So you're seeing a lot more demand and spending as we're having more dependence for individuals in the country. And even in some countries, so for instance in Japan, they've noted that an aging population is deflationary, because in Japan, which is one of the oldest populations by age, they've struggled in the last 20 years. Central bank has struggled to get inflation up. The only thing is, well, if you look at Japan, the people getting older and retiring, but you're also seeing a decrease in birth rates. You're not seeing the same thing in China and in the United States. You're seeing an increase in birth rates. So you're seeing more dependence, and you're seeing more people retiring from the market. So they're going to start to spend more of their money, right? The boomers contain about 50% of America's wealth right now, and most of the boomers are retiring if they haven't done so already. So they're going to have money to spend now and put more demand into the market to raise prices and cause inflation. And they also have more dependence that will be spending, and you're seeing a decreasing size of the labor market at this time, at least for the next couple of years. So we could just be seeing natural inflation as a result of that, as well as just people being able to spend more money. And the third major point here is the maturity of e-commerce. So almost as of now, almost about 15% of retail sales come from e-commerce, as opposed that's 5 times greater than it was in 2005, which is natural progression, I would say. And price transparency and fast delivery among these companies forced businesses to compete. They call this the Amazon effect. So it kept prices low and kept everybody in control. And as people like Uber and Airbnb also help drive deflationary pressures, because these digital platforms, their goal was to get as much market share as possible, not necessarily profit. So their goal was keep low prices, keep everything under control, get a big client base. But now a lot of these companies are being pressured for profit. So you're seeing prices in Uber rides going up, your Lyft rides, you're seeing prices in Airbnbs going up. You're seeing them try to get more margins now. So now their goal is to make money on the market share that they have. So you're going to see some natural price increases there as well, because over 2015 to 2019, the average year retail prices fell 4% a year, but that's been reversed as of COVID in March 2020, 2%. As we move into a more technology-driven society, we may start seeing more higher and higher prices in online retail because more and more people are using them. There's much more demand. coming from there. And a new survey by the Wall Street Journal of some economists showed an estimated level of inflation at 2.58% from 2021 to 2023, levels not seen since 1993, so definitely higher than 2% target inflation. 58% of those economists don't see the Fed raising rates until at least 2022, which is fine because we think they might be raising them by 2023. And the Fed's preferred inflation gauge, the overall PCE index, which includes food and energy, rose 3.9% in May, which is almost twice as much as the 2% target. So we know the Fed is saying, hey, we've been dealing with low inflation for the last like 10, 15 years, and especially out of COVID, we want to make sure we balance the markets and unemployment with higher amounts of inflation. But at what point does it become too much, right? At what point do you because the argument is still here, is it transitory or is it going to stick around for a period of time? And really, no matter what you see here, no matter what you think, higher inflation is going to be disruptive to consumers, to markets, to homeowners, to policymakers, to businesses, planning their expenses, buying things, selling things, paying off debts, eating away at earnings, eating away at gains in markets. So either way, inflation is up, even in the short term. If it is transitory, in the short term, you're going to see that they might start having these effects in the markets, even though it looks like the markets are shrugging it off, because I think there's a battle here between market participants as well. People piling into bonds and saying, listen, we think it's going to be transitory versus people who don't think it's going to be transitory, right? People who think this is going to end and things are going to go back to normal versus people who think it's going to stick around for a while. So definitely those are three big factors. And I thought that was really interesting. I thought those were really interesting points about how we could see inflationary and deflationary pressures that have nothing to do with markets or, necessarily with debt. It has everything to do with just the people in the economy, the workforce, their spending habits, and the way business is done, and just the growth of technology. So we could just be seeing some natural drivers of inflation in the next couple of months, next couple of years in general, besides the COVID fiasco. So, yeah.
Okay, definitely something to look out for.
Oh yeah.
Not fun. Great. Joy. Hello. And with that, we can go
Inflation.
into our...
Josh just had a little bit of a stroke there.
No more inflation. Oh, geez.
And with that, we can go into...
It's going to make your Adidas shirts cost twice as much, Josh. I'm going to buy so many anymore.
I'm just like, I can't even... Can we, go through deflation, please? Can we just increase the value of money and go the other way? Just, the other way.
You don't want lots of deflation because then you get stagnation. Nobody wants to make anything. Everything buys too much.
Buy crypto.
That's not the solution or in relation to this problem. That's not. No. Not considering. No, you can buy crypto, but it's not the solution to this problem.
And with that, we will. Let's see. We will be back in just a few minutes with crypto news and with stock market updates. So come on back.
All right, what's up, guys? So let's talk about Credit Suisse and how they're in deep water right now. So Credit Suisse Group is a global investment bank and financial services firm from Switzerland. So when we look at them, they got a new chairman, and the new chairman is making cuts in the company following a $10 billion loss due to the collapse of the supply chain finance firm Greensill Capital and Archegos Family Fund. And if you don't know who Archegos Family Fund is, let me do a quick recap on that. So Archegos, these guys, this one man, he in his portfolio, he had $20 billion. He was able to get 5 times that leverage from different primary brokers such as Credit Suisse, Morgan Stanley, Goldman Sachs, UBS, and another one, Nomura Holdings. And they allowed him 5 times that for him to trade with. So he was able to trade up to $100 billion. Now that is kind of absurd when you only have $20 billion in your account, only as though I'm saying that's a small number. No, that's a lot of money. And he was given $100 billion. Well, on March 25th, he got margin called at a $30 billion loss. Oof. And that whole fund, boom, imploded. It was gone. It collapsed out of nowhere. Guess who's stuck with the bill? The primary brokers. No, Credit Suisse. Thankfully, the American people, I don't know, they get stuck in there somehow. But right now, it's all about how Credit Suisse is on the hook for $5.5 billion loss for that. And then there's Greensill Capital, which was another part where the Swiss bank's fund client, they have to fund their clients because they've been kept waiting for repayment from a failed supply chain product. So that was Greensill Capital, in which they've been paying back. They returned $4.8 billion of the funds invested in the supply chain notes to clients, but there are still $5.2 billion that they still have to return to clients. So they're on the hook right now for a lot of money. So that's why they're making all these cuts. So we could talk about the cuts right now and see that Credit Suisse Investment Bank CEO Brian Chin and Chief Risk and Compliance Officer Laura Warner have stepped down. Another one, Floriana Scarlato, has served as a Chief Compliance Officer of the International Wealth Management Division of Credit Suisse since 2015, but has been with them since 2005. And that's the thing, the new chairman's going in, taking out people, and also people that have been there for a long time are just stepping down on their own fruition. So, or volition. So Horta Osorio, he's the new chairman who took over 2 months ago, has vowed to scrutinize risk management and culture following Credit Suisse's serial mishaps. I mean, when you look at Credit Suisse, their market cap is $24 billion. Their loss this year is $10 billion. That is more than they've ever made in the past 10 years. They lost within a couple months. So that's just what shows when these guys get too greedy and they think, all right, well, this guy's rich. He could probably make these big moves. Well, see, black swans happen. Things happen. And this guy took a huge hit. You know, the guys that came out unscathed from Archegos Family Fund was like Goldman Sachs and Morgan Stanley. When they saw the writing on the wall, maybe insider information, I don't know, but they got out nearly unscathed. Yeah, a couple $1 million here and there, but it wasn't in the excess of like billions of dollars. So that's where we gotta just realize that these guys, there is no stopping them when it comes to how much leverage they're willing to put out to people. Hopefully right now they're going to be able to learn from their lesson of how much they will actually give out in loans. And so we'll see what happens in the future. But as of right now, Credit Suisse from March 25th they took around a 20% hit from $13 to $21, and as of July 8th, there was a buy order for 15 million shares, around 50 million shares. So we'll see their volume spike back up. We'll see if that's just to make sure that there is no more of a windfall for that stock, or it's just a repeat of March 25th when that volume spiked up and then they started dropping again the next couple of days. So that's always something to watch out for, because they'll fake you out. They'll be like, oh, it's going back up. People buy in, but then they really just want to drop out at a higher price. So
Interesting.
Nice.
So
Yeah, man.
is this a high risk? Is this a buy, or is this a watch out?
see, this is a banks one by one are going to start defaulting because of COVID, because of bad business acumen, because of a plethora of I don't know, ideas, not ideas, like footsteps. Like they've made their bed. They're now going to start sleeping in it, because from this, it's just one bank that needs to default, and then another one does, and then another one does, and it's just they have seen that hedge funds right now are over leveraged, historically over leveraged. Where are they getting that leverage from? Let me tell you, it's from these premium brokers, primary brokers. And when those guys start defaulting, because let's say like the shorts for like AMC and GameStop, how much money they lost was in the excess of billions of dollars. I don't know the exact amount, but I believe a month ago for AMC, shorts lost around $30 billion. And guess where that's coming from? That's coming from hedge funds. That's coming from these institutions and stuff. So wherever they're getting their leverage from, you better know that the primary brokers, the banks, are going to take a hit. And it's just going to start going on one by one. It's going to be a domino effect. And one by one, they're going to start defaulting. And other big guys, other big institutions that have been, just doing the right moves are going to start buying them up. Or they're just going to wait till auction, and then they'll have the government auction them off. So
No, the government's never going to let the banks fail. You can't let the banks fail.
well, that's why there's a wind down plan, right? And that's where when they fail, they're not going to fail completely. The government's not going to want to bail them out. They're going to say, hey, who now wants this machine? Who could actually drive it better? And they're going to have other large institutions pick it back up, buy them, and they're going to be at a much lower price, such as UBS wanted to merge with Credit Suisse, and they were supposed to be at like equal standing. Now I don't even believe they're at equal standing. They're at what, half the market value of what they were before. So UBS could get a much better price on them.
They could. They were still going to buy them. It wasn't, as long as the regulators didn't stop them from having an antitrust liability for having giant banks merge.
And see, that's the thing that could, when you really look into it, there's antitrust and this and that. Well, that's going to all get thrown out the door when a whole bank defaults, and another bank is just like, dude, I want to buy them up. Why not? I'll just have a better footing in the market and be a better primary broker. And then guess what? Instead of 100 roads leading to Rome, there's only going to be about 50, because only of the 50 top guys are now standing, and they bought up the other 50 that defaulted.
Maybe could also be helpful to the market to get rid of dead weight.
Dead weight, but that's the thing.
Inefficient banks get absorbed by more efficient banks.
Yeah, and hopefully it'll turn out better. But these rules that have been put into place by the SEC, it should help in the event that banks default. That it's not going to be, oh my gosh, we didn't see this coming. no, we saw this coming. We have plans for it now. So go according to rule, blah, 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 you know?
No, Jim, we saw this coming.
Exactly.
Okay. So, that just reminded me of a random meme. It's like, no, Jim, women want flowers. We just don't want to tell you we want flowers, but we want flowers. And with that,
Thank you.
just you're welcome. I feel like I had to give the backstory on that one. With
Yeah, that was
we're
the
gonna
backstory.
just
It's a
jump.
meme I saw.
We're gonna just jump straight into crypto news because this is where it's at. This is where the real talk comes in. Real talk. And let's
It's been the lies. The lies arise.
It's the penny stocks.
Lies and
get
max.
it in there.
Here comes the largest amount of speculation you'll hear all week.
Hi guys, welcome to Random Rabbit Crypto Section. Whew. All right, we're coming back. So, TikTok is on the radar today because they do not want you taking financial advice from their platform. This comes after a lot of crypto people are jumping onto TikTok and talking to individuals who are younger than the age of 18 who should not be making financial decisions but have access to a lot of money. What they're doing is they are now restricting any type of cryptocurrency advertisements and or exchange or investment tips, products, financial services, things of that nature. And why this is good is because, one, if you're going to TikTok for financial information, you are not investing. You are not doing anything that's going to be helping your future. The things that we talk about here are usually not on social media and they're not on TikTok. What we will do is we will laugh about some of the ones that are on social medias and TikToks, but I see this as good information.
Take my money. That's literally what they say on TikTok. And the TikTokers are just like, oh, take your money.
It's so true.
I'm already in on ADX, but guess what? You're going to hop that up and I'm going to ride that pump up because I'm apparently an influencer now. And then at the top, I'm going to dip out and be like, hey, there's a better coin. That's how it works all the time on these social forums for pink slips. And they're moving it over now to TikTok. That's crazy.
This is absolutely expected. When you have an increase in retail investors, you have a collection of the people that want to make money on them. And if you can't make money trading, then you'll make money or try to make money by getting followers as the person who gives advice. And they capitalize on this market while the market is hot. Lots of people want to be investors. Lots of people use TikTok and social media. So you put those together. Next thing you know, you got people on social media who aren't giving you discussions, who are just putting out little videos all day telling you what you should buy and shouldn't buy and getting you hyped. They don't care what happens to you. They're just trying to make money. But you should always do your due diligence no matter where you go to invest in anything, period.
With that, it is in their contract to allow them to remove any type of information along the cryptocurrency line. So this is all within their power. Nothing's being done unfairly. And there's going to be new SEC rules that have been said. They're going to come out by the end of this month, July 28th. And so we will wait to see what new rules come out and regulations in order to, continue this train, continue the process. But as we continue, we see we're going to just shoot through some big news. We got Square over here saying that they are building their Bitcoin hardware wallets. This is just bigger confirmation for large companies to jump into this crypto mania and get their products out there. They want to make it so that it's easier for people to use and have interactions every day with their cryptocurrency. And so this I see as this is pretty big. You guys' thoughts? This is just all positive news for cryptocurrency.
It just makes it like it's just that it's everybody wants to take a piece of it. So everybody, any payment system that doesn't include the ability to pay with cryptocurrency is you're just missing out on part of the market. I don't I would expect that all payment systems and most companies, small businesses will have a way of implementing crypto uh, asset payments in their stores. Why? Because as a business, if you know there's a big hype and they're using this, if you allow them to pay with that, then you're going to make more money. And if you create wallets there, then you can allow them to be a part of your system and use your wallets or the wallets that you've designed or that are part of your network. So again, it's the market is supply and demand. The market is hot, so everyone is going to jump into it. Any derivative way you can extract value out of something that is currently trending, people are going to do it.
We are going into the future, and that is being able to transfer money from like a little USB, and you're like, hey man, get yourself a meal or something, and then like bada bing bada boom, instant transfers in real world time.
And but we already have that.
Yeah, but this is with crystals and like with other mystical futuristic things. Keep up, Wyatt, keep up.
Crystals are older than mankind.
They've been around. With that, crystallization, we're talking about from crystals to diamonds. There was a diamond sold for over $12 million using cryptocurrency. Wyatt, tell me it is not money. It is not valued as gold. That it is not illegal. I'm just kidding. It's not illegal tender. But this is crazy.
Look, if something costs X amount of money and there's an asset that you can acquire that is equal to that amount of money,
that is liquidatable.
That is liquid. That is liquid. Not liquid. As long as it's a liquid asset. And the two parties agree to trade that asset, and you can get enough of the value representatively to compare to these two things and say this is the same as that. Of course, that's like if this is $12 million, and if someone says I'll accept $12 million in Beanie Babies, well, if I go out and buy $12 million of Beanie Babies and bring it to their house, and they say that's acceptable. Beanie Babies are the future, Josh.
This is amazing.
There was a future back in the day. Now I don't know.
Now it's all about digital Beanie Babies.
I'm just saying they're gonna have like Neuralink, and they're gonna have the chip in the arm, and then you're gonna be able to pay just like that, and there you go. They'll retina scan you and everything.
This right here, this is the future of purchasing power. Diamonds, baby.
You could have bought that
diamond teeth with my crypto, just full grill.
Just because you have crypto doesn't mean you own any more money than you did before.
No, I pretty much own this diamond as well. I am part owner.
You are part owner of this diamond?
Yes.
So how do you actually get ownership of it? Do you like borrow it for like an hour? They come over to your house and like Josh, and you just get the whole thing. You're like,
It's also an NFT, so it's on my phone.
So
you wouldn't understand. It's
I would completely understand that you would just you paid for partial digital ownership of a diamond
using feel like this digital asset. Is the equivalent of Pokemon cards back in the day, and now valued at a much higher rate now. NFTs.
I think NFTs are worth so much money because it's such a new market, and everyone's excited. Like, you have to understand that there's always market forces, and that's why economics is a soft science deals with psychology. People are excited to buy NFTs, so you're getting a premium markup as a result of people wanting it. It's like Apple. People love the design so much they'll pay for the brand, so they can mark the shit up on their products, and you'll pay an extra $200 for the same amount of processing power as like an HP computer because it's the Apple name. Right now, NFTs are hot, so people know like if I add an extra like $200 to my stuff because it's this new digital asset, people are going to want to pay for it.
So, with that, we come into some other realities of the crypto market, which is Binance and its ability to lose people's money and not give it back. But Binance froze on May 19, causing a crash, and some users have not been able to get their money back. And that's saying that some of them were holding a large position, and as soon as the crash happened, they were unable to, for I believe more than an hour, able to access their accounts and take any action at that time. So they're looking at big losses. Right now they're trying to figure out who's to blame. There's no address for Binance, and so
there's no
headquarters. So they're trying to figure out who's going to be the one to swallow this pill, because it is not going to be a happy lawsuit. And believe me, when there's a bunch of money involved, you're going to go down. You're going to go down very hard. And talking about going down very hard is going to be the Bitcoin price. So over the last month, it's dropped 40%. Now, if you're looking at the overall of, yes, the highs in May that hit 60,000, and then, we hit our lows of hitting 28,000, we are looking at about 40% drop. Now, this week they're saying there's some big indicators in the market showing some bearish crossovers. And so here, this all goes back to the amount of support that's needed at each level. We've been currently sitting between 32,000 and 34,000 in Bitcoin price. Now, we've been staying strong above 32. We're currently sitting at 33,000. We want to keep that support and go towards 38,000, and that's the possibility that we're looking at. But we are also seeing a possible decline in the Bitcoin price, and that could just be from everything that's been going on. So, this article is a great article that shows June was just not the month for cryptocurrencies, going on through with China shutting down their miners and different trades going through. Right now could either be the best time to buy, or we could be looking at another dip. Now, if you're looking at this as long term, you are looking at this as, yes, take this next dip. I want to buy at maybe the next low, the next floor that won't be seen in years to come. But if it hits, it's going to hit. They're saying they want it to hit closer to 20,000 at the price hold. We'll see. That'll be in the next week or two to come. So stay vigilant. We will keep covering this. And if you guys joined us yesterday, you guys were able to party with us over at the Known Origin to the Moon Music Festival. It was over on Decentraland. It was a blast. I know Wyatt was there. He was there mixing it up with the ladies, as he does virtually. He's just a unstoppable tank. The man is just smoother than butter, hotter than ice.
I went to a different realm for 10 minutes and then I left. Josh, however, found himself a nice redheaded mate that he stood next to for about 2 hours.
And so if you want to see it, it's right here.
Talk about those ones and zeros, bro. You know what I mean? True and false, true and false. True.
True. And so then we go over to the video section, and you'll find it right here. You have our music festival, and you can just pretty much come here if you missed it, and you can party with us. You could party with, let's see if you could hear the music through here. These are some of the friends I made. And I don't hear any music. It's pretty silent.
Way to let them all down, Jeff.
I know. What's going on? Oh, it's very soft music. You know what? This guy did bring like a lounge vibe. And so, if you guys want to check out that music festival, we got all like 3 hours of that festival on there, where we were just cruising and bumping, and we're also checking out Decentraland. So, with that, guys, that is our Random Rabbit show. Thank you for coming, and it's just Monday. Oh man, I feel like there's still so much to do.
It's just Monday, and the banks are just starting to fall.
The cascade.
Just to be clear, none of the banks have fallen yet. And
Not yet.
I shed serious doubt that Credit Suisse can't meet a $5 billion price tag. They have more capital than they know what to do with. I think Credit Suisse will pay it off, take a big loss. Their investors will get mad at them, and then more regulations will come about, transparency and risk taking. That's what I think will happen.
We'll see.
Well, with that, thank you, Random Rabbit Wyatt, Random Rabbit Jeremy. You guys have a splendid night.
You are so very welcome, Josh.
You are here for me because that is
Anytime.
That is what friends do. That is what people who are told to do something do. And
I'm here, Josh, because when you do die, I'm going to call dibs on all your stuff so I can burn it in the backyard.
Hey, I already called dibs.
Very spiteful.
You can go into the ashes and fish out the memories.
Very spiteful, but I like it.
100%. Absolutely nothing
I
to
like
spite.
it.
Well, guys, you guys have a good night. Peace out. Random Rabbit Nation, you guys have a wonderful night, and we'll see you guys tomorrow. Bye-bye.
Sounds good. See you guys.
Bye, everybody.